Stock market trading. Level 1. Technical analysis for professional traders. Market indicators. What exactly are market indicators? Market indicators are defined as a subset of technical indicators, which are used in predicting the direction of major financial indexes or groups of securities. Market indicators are very similar to technical indicators in that both apply a statistical formula to a series of data points to draw a conclusion. However, the difference is that market indicators use data points from multiple securities, rather than just a single security. Oftentimes, market indicators are plotted on a separate chart, rather than appearing above or below an index price chart. In a nutshell, market indicators measure the health of a group of related stocks, usually by measuring group participation in a trend. The group can be the members of a broad index, a specific sector, or even an entire market. It is important to explain in detail the difference between market indicators and technical indicators. Just like a technical indicator, a market indicator is a series of data points derived from a formula. In this case, however, the formula for market indicators is applied to the price data for multiple securities within the market instead of just one security. Price data can come from open, high, low, or close points for the securities, their volume, or both. This data is entered into the indicator formula and the data point is produced. However, unlike technical indicators, market indicators are not charted above or below the chart. Market indicators are what is being charted, and as such have often their own ticker symbols. There are often many symbols that apply the same market indicator formula to different markets. For example, the $BPSPX and the $BPNDX track the bullish percent index for the S&P 500 and the NASDAQ 100 respectively. Most market indicators are created by analyzing the number of companies that have reached new highs relative to the number that created new lows, known as market breadth, since it shows where the overall trend is headed. Basically, there are two most common types of market indicators, which are market breadth indicators. These compare the number of stocks moving in the same direction as a larger trend. Breadth indicators measure the number of percentage of stocks in the group that are participating in a trend. Market breadth indicators are typically based on the price data of the stocks in the group. Popular market breadth indicators include the advanced decline line, McClellan oscillator, and net new 52-week highs. The advanced decline line is calculated using the number of stocks in the group that increased in price versus the number that decreased in price. The net new 52-week highs indicator measures the difference between the percentage of stocks making new 52-week highs and those making new 52-week lows. Market sentiment indicators. These indicators compare price and volume to determine whether investors are bullish or bearish on the overall market. Not all market indicators measure market participation using price and volume. Sentiment indicators measure investor sentiment, whether investors feel bullish or bearish about the market. The data used to calculate these indicators vary more widely than the traditional market breadth indicators. It is often a count of the investors themselves or the volume of money they are investing, rather than price and volume. Popular sentiment indicators include the put-call ratio, volatility indexes, and the decision point right-X ratio. The decision point right-X ratio is calculated using the amount of money invested in bullish and bearish mutual funds. The AAII sentiment indicators are based on poll results of investors. The put-call ratio looks at the number of put options versus call options during a given period. Here's an example of the NASDAQ Advanced Decline Issues Index. Popular market indicators. There are hundreds of different market indicators covering various indexes in the United States and around the world, including the New York Stock Exchange, NASDAQ, Amex, TSX, TSXV, and various options exchanges. Some of the most popular market indicators include primary indicators. Most investors rely on a few favorite stock market indicators, and new ones seem to pop up all the time. But the two most reliable ones for determining the strength of the market are price and volume. Most other stock market indicators are derived from price and volume data, so it stands to reason that if you follow the price and volume action on the major market indices each day, you will always be in sync with the current trend. Using price and volume to analyze stock market trends while incorporating historical stock market data should be all you need to discern the current market's strength and direction. That said, secondary indicators can also help clarify this picture. Secondary indicators. Number 1. Advance or decline line. This plots the number of advancing shares versus the number of declining shares, the ratio of advancing to declining securities at any given point in time. At times, a small number of larger weighted stocks may experience significant moves up or down that skew the price action on the index. This line and its accompanying data reveals whether a majority of stocks followed the direction of the major indices that day. Examples: $NYAD and $NAAD. Number 2. Short-term overbought, oversold oscillator. This is a 10-day moving average of the number of stocks moving up in price less the number of stocks moving down in price. Stocks with prices that did not change from the previous close are not included in this calculation. Some investors may use this indicator to take a contrarian position when the market has moved too far in one direction over a short period of time. Number 3. 10-day moving average up and down volume. Two 10-day moving average lines are presented to illustrate the volume of all stocks on an exchange that are moving up or down in price. Many market indicators look at the percentage of stocks above or below key moving averages, such as the 50 and 200-day moving averages. Blue line, a 10-day moving average of the total volume of all stocks on an exchange moving up in price. Pink line, a 10-day moving average of the total volume of all stocks on an exchange moving down in price. When the two lines cross, this may indicate a trend change in favor of whichever line is moving up. Examples: $NYA50, $NYA200, $NAA50, and $NAA200. Number 4. 10-day moving average, new highs and new lows. This is a presentation of two 10-day moving average lines to illustrate stocks reaching new highs and new lows corresponding to their specific exchange. It shows the ratio of new highs to new lows at any given point in time. When there are many new highs, it's a sign that the market may be getting frothy, while many new lows suggest that a market may be bottoming out. Blue line, a 10-day moving average of the number of stocks making new price highs. Pink line, a 10-day moving average of the number of stocks reaching new price lows. When the two lines cross, this may indicate a trend change in favor of whichever line is moving up. Other secondary indicators include the McClellan oscillator. This oscillator uses a moving average of highs and lows to help smooth out market breadth and make it easier to interpret than looking at choppy charts showing the raw numbers. It ranges from plus 150 to minus 150. Sentimental indicators. New York Stock Exchange short interest ratio released by the exchange. This is the ratio of all short-term interest on the New York Stock Exchange divided by the average daily volume. As this ratio increases, it's a sign that market sentiment is becoming increasingly negative because more investors are taking short positions. However, when this ratio nears extreme levels, it can be used as a contrarian indicator. Bulls versus bears ratio. Published by Investors Intelligence, this sentiment indicator is the result of a poll of market professionals. Simply put, it's the ratio of those professionals who have a bullish outlook on the market versus a bearish one. Just like most other sentiment indicators, this ratio can be used as a contrarian indicator when it nears extreme levels. Economic calendar. An economic calendar is a list of current and upcoming announcements for a variety of economic indicators. It includes the period the announcement covers, as well as the consensus estimate for each indicator, if available. The market tends to react favorably when positive numbers are reported. Keep in mind that the market may have already priced in the result of the announcement based on the consensus estimate prior to the announcement. Thus, when the reported numbers fall short of the consensus estimate, the market may react unfavorably. Other psychological indicators. There are many other sentiment indicators that attempt to capture how market participants feel about the current environment. They all tend to work with varying degrees of success in particular situations, but the best indicators for portraying actual market strength are the ones directly derived from actual market price and volume data. Here are a few other sentiment indicators to consider for market directional analysis. The CBOE Market Volatility Index, price premium inputs versus call ratio, the number of stock splits in the prior 30 days, new issues in the last year as a percentage of all stock on an index, price to book value of an index, price to earnings ratio of an index, current percentage dividend yield of an index. Stock market indexes. The UK's FTSE 100, Germany's DAX 30, and France's CAC 40 are three popular European stock market indexes. In many ways, they're comparable to the Dow Jones or S&P 500 in the United States in the sense that they are a proxy for the broader market. Britain's FTSE 100 Index. The FTSE 100 is an index created by the FTSE Group that represents the 100 most highly capitalised companies in the United Kingdom, listed on the London Stock Exchange. Investors looking to invest in the FTSE 100 can either purchase foreign ETFs, such as the iShares FTSE 100, or purchase individual components in the FTSE 100 using American depository receipts. Popular companies in the FTSE 100 include BP plc, BHP Billiton plc, and GlaxoSmithKline plc. Germany's DAX 30 Index. The DAX 30 is a popular index consisting of Germany's 30 largest companies trading on the Frankfurt Stock Exchange. Investors looking for exposure to the DAX 30 index can consider purchasing foreign ETFs, like the iShares DAX 30 ETF, or purchasing individual components in the DAX 30 using ADRs. Popular companies in the DAX 30 include Siemens AG, BASF SE, and Bayer AG. France's CAC 40 Index. The CAC 40 is France's largest index and consists of its 40 largest companies, of which the majority are domiciled in France. Investors looking to buy a piece of the CAC 40 can either purchase foreign ETFs, such as the Lixor CAC 40 ETF, or purchase individual components of the CAC 40 in the form of ADRs. Popular companies in the CAC 40 include Sanofi, ArcelorMittal, and Total SA. The Euro Stoxx 50 Index. The Euro Stoxx 50 is a leading index of Europe's 50 largest blue-chip companies that span 12 Eurozone economies. The Deutsche Börse, Dow Jones, and SWX Group maintain the index and select its components based on a number of different criteria. Investors can gain exposure to the index through ETFs or ADRs. Some popular US-based ETFs tracking the Euro Stoxx 50 include SPDR Euro Stoxx 50 ETF, iShares Euro Stoxx 50 ETF.